to welcome in now Eddie Gabor, who is the owner of Key Advisors Wealth Management. Eddie, thank you so much for joining us today. It's good to see you. I haven't talked to you in a while. All right, so Eddie, you say, this is a quote from you, this is the most hated raging bull market of my career. Why do you think it is the most hated raging bull market?
I think it's most hated because most have missed it. You know, the V-shaped recovery that we saw was no one's base case. It wasn't our base case either, but when the facts changed and the numbers changed, we changed with it quickly and fortunately started dollar cost averaging back into the market in April after raising cash on March the 3rd. And so the more and more hated this becomes, and you continue to hear calls for a recession or the market's overpriced, when you start to hear these things and continue, to me, that makes the bullish case even more. And this is why I think you're seeing on these big dip days, you're seeing the market come back because so many people missed it and there's so much cash on the sideline that in order to make their numbers look good for this first half of the year, I believe you're going to see these big funds and hedge funds buy dips because they need to get in if they miss that first move of the market. So, and lastly, we don't see a recession. Matter of fact, we think growth is going to accelerate to the upside over the coming quarters, supported by the wage increases we're seeing on the consumer. So right now, we think we're in a Goldilocks market, and until the data changes, we're going to continue to stay bullish.
Okay, so continue to stay bullish. Do you think that we are going to see, as a consistent theme, further risk on?
I do think it's going to be a risk on. And look, we know things aren't going to go straight up. I can see a scenario where maybe the S&P gets to that 6,100, 6,150 and then sells off. Maybe we get a 4 to 5% correction. But I think because of the amount of cash on the sidelines and the buying that's going to be forced, I think they're going to be really shallow sell-offs this summer. And I think the theme should still be, for the right risk tolerances, to keep buying those dips. Because when we look out over the rest of the year, if we get this bill passed in some form or fashion, tax cuts and the trade deals are behind us, the market has quite a bit of runway here over the next 6 to 12 months.
You know, Eddie, look, you make a great point. Even, you know, earlier today, we saw this push towards 6,000 on the S&P 500. And so it seems like there's this fight there. And, you know, we've pulled back and been kind of range bound today. But it does seem like there is still some momentum under the hood. But let me ask you this. I'm curious to know your views on, given that you mentioned this aggressive dip buying, what sectors do you think or specific areas that you think are most positioned for more momentum?
I think you want to focus on the areas that got hit the hardest that still aren't back to where they were at their highs. And so we increased its positioning in consumer discretionary. We actually bought a little bit more today thanks to the big sell-off on Tesla. That ETF's taken a big hit, as well as semi-conductors. I mean, semi-conductors really for almost a year now have not really performed that great on the ETF side. So we increased our positioning there, and we're getting some momentum there. And then lastly, probably one of the most hated areas, and I've hated it because we've gotten burned on it over the last year or so. When we entered, we ended up getting out, but small caps. And small caps are quietly outperforming on a relative basis. Today's another great example of that. So our theme is the economy is going to get stronger over the coming quarters. We think small cap stocks will certainly be an outperformer if we're right on that call. If we're wrong, like we were last year, we'll quickly exit. But I think we're seeing a lot of positive signs here that small caps may potentially finally break out.
No, look, that's a great point about small caps because there was talk about it, you know, being the catch-up trade and that it would catch up, especially at the beginning of this year. Then we had all that volatility at the beginning of April that really, you know, just called into question a lot of the beyond small caps, just, you know, the progress in the S&P 500. We knew this year wouldn't be the same as the previous 2 years, but I don't think at the beginning of the year when we got to April, we would expect it to be as bumpy as it was. But look, we've made almost this round trip when it comes to the S&P 500. Let me dive into that point that you made about, look, it's not necessarily going to be straight up. Could potentially see a, you know, say a 5% correction. How do you navigate that volatility?
So a 5% correction to us would be nothing that we would worry about having to raise a lot of cash. Actually, what we would do in a 5% correction scenario is we would probably rotate some of our S&P 500 exposure into ETF SPY and probably take some off of that and add to the higher risk areas. Because on a 5% correction, we would anticipate small caps, consumer discretionary names to take a bigger hit than that 5%. So we would actually look at that as an opportunity to rotate into higher beta stuff, because we do think, post July, we're going to really see this market make a big leg higher.
Okay. You made the point about the economy. I mean, there were for a while all these calls about a recession. Now there are some those calls have gotten quieter, right? But there are still some concerns about the economy, because we are seeing some weakness, not just in the soft data, but some of the hard data. What's your view from here about the economy?
So we think the economy, until the labor market really breaks down, and it doesn't look like that's going to happen here in the coming quarters, we're not concerned with the economy. And the other thing is, we're taking a look at these wage increases. We know Americans love to spend money. You put more money in their pocket, it's going to go into the economy. And lastly, whether you agree with it or not, this bill is going to pass in D.C. in some form or fashion, and the net result is going to be more money printing. I know Elon's coming out today bashing the bill, but regardless of what form or fashion, the net impact is going to be more money printing. And unfortunately, that is bullish. I say unfortunately because I don't think increasing debt is smart, but it's going to add fuel to an economy that doesn't need it. So when you look at the debt, you look at the consumer, and you look at the labor market, it's really hard to find a case as to why you would short this market or bet against this economy right now.
No, Eddie, you make good points. And like I've heard this consistently, never underestimate the American consumer, because we as Americans love to spend, right? And so as long as you have a job, you'll keep spending. I'm curious to know if you were concerned at all about that ADP jobs number. I know that, nowadays it often diverges, but they used to have more closer parallels with the non-farm payrolls report. Did it concern you at all, seeing that the private sector only grew by 37,000 jobs in May?
No, one data point is not usually going to cause some major alarm for us or change our thesis. We need to see some consistency on that. And I think the labor market can get weaker without even coming close to a recession. So I don't think we're anywhere near where we need to be worried about. And we'll see tomorrow. There's some more data coming out tomorrow and then in the coming weeks. Now, if the trend starts to get weaker and weaker, that's a completely different story. But I think the consumer is going to continue to be resilient and prove many wrong. And look, I was one that thought we would have a recession, and we didn't. And we were wrong, and we pivoted. And I think in this business, you have to have the humility that when the facts change, you have to change with it.
Oh, that's a great point. And that is, well done and falling on the sword there. I'm curious to know what data points give you the conviction where you are now.
So again, I think many things, but I think the worst is behind us, right? The trade war is what really caused this major sell-off. And I think the probability of news over the coming months will be more positive than negative on the net effect. The other thing too is, I can't stress enough, when we're seeing these wage increase at the levels that they're increasing, that's telling us that this inflation is going to be able to be absorbed to a certain extent because wages are going up. And so that's something that is a net positive, not just to everyday consumers, but to the economy. And look at these earnings reports that are coming out. We are seeing pretty solid earnings. And again, going against what many consensus was expecting this year. And so we think we've seen the worst of the economic data. And from a rate of change perspective, historically, when you see the rate of change of the economy growth accelerating, that has generally been a really good thing for equities. And I think that's why the equities are doing what they're doing now. They are forward looking, they're very smart, and they're sniffing out the data that's going to be coming up in the next few months, which to us is going to be very bullish.
All right, Eddie, thank you. That's Eddie Gabor, Key Advisors, Wealth Management. We appreciate your time and insight. Great perspective.